Before we begin, a quick and important disclaimer. The following content is provided strictly for educational and entertainment purposes. It does not constitute professional legal, financial, or tax advice. Divorce law and retirement account regulations are subject to complex state-specific statutes and federal oversight under the Employee Retirement Income Security Act of 1974. Every individual case is unique, and historical trends do not predict future results. Viewers are strongly encouraged to conduct their own due diligence and consult with a licensed attorney, a certified public accountant, or a qualified financial advisor before making any decisions regarding their marital assets or retirement accounts. In the final scene of an American independent film, we often see the protagonist walking away into a sunset of ambiguity, but what the credits never show is the grueling legal battle over the 401k plan that was funded during the marriage. For most independent filmmakers, actors, and crew members in the United States, the 401k is not just a line item on a balance sheet. It is the only safety net in an industry defined by feast and famine. Yet, a shocking reality persists. In nearly 50% of American marriages that end in dissolution, the retirement account becomes the most contested and misunderstood piece of property, often leading to a loss of 30 to 40% of the total value due to simple procedural errors. We are entering a masterclass on the intersection of creative life and legal finality. This is not about the romanticized heartbreak you see at Sundance. This is about the clinical, cold reality of the Qualified Domestic Relations Order and the survival of your financial future. This deep dive solves the most critical problem facing the creative class today: the preservation of long-term wealth during a life transition. If you are a freelancer, a small production company owner, or an employee within the American film ecosystem, understanding the mechanics of a 401k divorce is the difference between retiring with dignity and working on sets into your late 70s. We will break down the precise historical trends of asset division, the technicalities of federal law that override state preferences, and the specific case studies of how creative professionals have navigated these waters without losing their entire production budget to the IRS. To understand the 401k in a divorce, we must first look at the American independent film landscape as a microcosm of the modern gig economy. Unlike corporate employees at major studios, indie workers often have sporadic contributions to their retirement funds. A director might contribute $20,000 in a year where a film sells to a streaming service, followed by 3 years of zero contributions. In the eyes of a divorce court, this erratic pattern creates a nightmare for valuation. The court must determine what is known as the coverture fraction. This is a mathematical formula used to determine the portion of the 401k that is considered marital property. The numerator is the number of months the participant was in the plan during the marriage, and the denominator is the total number of months the participant has been in the plan. Consider a hypothetical case study of a cinematographer who started a 401k in 2015, married in 2018, and filed for divorce in 2026. Even if the cinematographer was the only person putting money into that account, the law in most states views those contributions made between 2018 and 2026 as community or marital property. In a community property state like California, which is the heart of the American film industry, the starting point is a 50-50 split of all assets acquired during the marriage. This means that if the account grew from $50,000 to $200,000 during the marriage, the spouse is potentially entitled to $75,000, regardless of whether they ever stepped foot on a film set. The complexity deepens when we introduce the concept of the Qualified Domestic Relations Order, or QDRO. This is a legal instrument that many filmmakers ignore until it is too late. You cannot simply write in a divorce decree that you are giving your spouse half of your 401k. The plan administrator, the entity that actually holds the money, is bound by federal law under ERISA. They cannot release funds to a non-participant spouse without a QDRO that is drafted to their exact specifications. Historical trends show that many divorcees leave their settlement with a signed decree but no QDRO, only to find out 10 years later that they have no legal claim to the funds they were promised because the paperwork was never approved by the plan administrator. In the realm of independent film, where many are technically self-employed, the solo 401k presents even more hurdles. A solo 401k allows a filmmaker to act as both the employer and the employee, maximizing contribution limits. However, during a divorce, the lack of a third-party plan administrator means the filmmaker is often responsible for the valuation and the distribution process themselves. This creates a high-stakes environment where one clerical error could trigger a 10% early withdrawal penalty from the IRS and immediate income tax liability on the entire balance. Let's look at the data regarding the impact of these splits. In the United States, the median 401k balance for individuals approaching retirement age is significantly lower than what is required for a comfortable lifestyle. When that balance is halved during a divorce, the time cost of recovery is often insurmountable. For a creative professional in their late 40s, losing half of a 401k means they must achieve an impossible rate of return or double their contributions for the remainder of their career just to return to their original baseline. This is why the negotiation phase of an indie film divorce often centers on offsetting assets. A savvy filmmaker might choose to give up the equity in a primary residence or a library of film rights in exchange for keeping their 401k intact. This is a strategic move because the 401k is a tax-advantaged vehicle, whereas a house has ongoing maintenance costs and a film library has a depreciating value. Furthermore, we must address the emotional labor of the indie film divorce. In cinema, we see the screaming matches and the dramatic exits, but the reality is found in the spreadsheets. The process of discovery requires both parties to produce every statement from the date of marriage to the date of separation. For a freelancer with multiple side hustles and various retirement accounts like IRAs or old 401ks from previous production gigs, this can involve hundreds of pages of documentation. If a filmmaker cannot prove that a portion of their 401k was separate property, acquired before the marriage, the court may default to assuming the entire balance is marital property. This is a potential outcome that catches many off guard, emphasizing the need for meticulous record-keeping from the very first day of a career. Historical trends in American family law also suggest a shift toward equitable distribution in non-community property states. In these jurisdictions, the court has the discretion to divide assets in a way that is fair, but not necessarily equal. If one spouse supported the other through film school or worked a corporate job to provide health insurance while the other was directing low-budget features, the court might award a larger portion of the 401k to the supporting spouse. This reflects a recognition of the human capital invested into the filmmaker's career. As we move forward in this deep dive, we will examine the specific tax traps that exist for those who try to move 401k money without a QDRO. We will look at how the 1984 Retirement Equity Act changed the game for spouses of film professionals, and why the valuation date is the most important day in your legal calendar. Whether the market is up or down on the day your divorce is finalized can swing your net worth by tens of thousands of dollars. We are not just talking about money. We are talking about the ability to continue creating art without the shadow of financial ruin. The American independent film scene thrives on risk, but when it comes to the 401k, the goal is total risk mitigation. We are building the blueprint for that protection right now. The blueprint for your financial protection begins the moment the decision to separate is made. But in the fast-moving world of American independent film, the legal clock often starts before the emotional one has even finished. To understand the stakes in 2026, we need to look at the specific technical hurdles that hit creative professionals harder than almost any other demographic. Imagine a character named Alex. Alex is a veteran line producer in Atlanta who has spent the last 15 years jumping from one independent production to another. Over that decade and a half, Alex has been meticulous, rolling over small 401k balances from various production company plans into a single, consolidated 401k account. By the start of 2026, that account has grown to $300,000. Alex married a talented production designer in 2020, right as the industry was shifting. Now, in 2026, they are facing a dissolution of marriage. The first major hurdle Alex faces is the tracing nightmare. In the United States, the burden of proof lies with the person claiming an asset is separate property. Because Alex consolidated those funds, the marital contributions are now commingled with the premarital ones. Without a clear baseline valuation from the date of the wedding in 2020, a court might look at that $300,000 balance and struggle to determine what Alex owned before the I do. Historical trends show that without precise documentation, like the year-end statements from 2019 and the first quarter of 2020, the court may default to an equitable distribution of the entire balance. For Alex, failing to produce a single PDF from 6 years ago could result in a loss of over $50,000 in premarital savings. Furthermore, we have to consider the radical changes introduced by the Secure Act 2.0, which are fully operational in 2026. One of the most significant shifts for the independent film community is the long-term part-time, or LTPT employee rule. Prior to this, many indie crew members were excluded from 401k plans because they didn't hit the 1,000-hour per year threshold at a single company. But as of 2026, the requirement has been reduced to just 2 consecutive years with at least 500 hours of service. This means more cinematographers, editors, and grips than ever before have active 401k accounts that are suddenly subject to division. If Alex's spouse was working as a part-time consultant for an indie studio and qualified for a plan under these new rules, their 401k is also on the table. This leads us to the step-by-step process of the valuation freeze. In a high-stakes divorce, the value of the 401k is not a static number. It is a moving target. In early 2026, the North American box office is projected to reach record highs of $10 to $11 billion, buoyed by a strong slate of independent breakouts and blockbuster sequels. This economic optimism often translates to market growth. If Alex and his spouse file for divorce in January, but the final decree isn't signed until November, the value of the 401k could fluctuate by 20%. Plus one. There are 2 primary ways the court handles this. The first is a flat dollar amount, where the spouse is awarded a specific sum, say $75,000. The risk here is that if the market crashes before the transfer is complete, Alex is still on the hook for that $75,000, which might now represent a much larger percentage of his remaining total. The second, and more common in 2026, is the percentage of account as of date of distribution, which includes gains and losses. This protects both parties from market volatility, but it requires the QDRO to be drafted with extreme precision. If the wording is vague, the plan administrator will reject it, and Alex will be stuck in a loop of legal fees and revisions while his assets remain in limbo. Imagine if Alex decides to bypass the QDRO and simply buy out his spouse. He might think, I'll give them $80,000 in cash from my savings, and I'll keep my $300,401,000. On the surface, this looks like a win for Alex because he keeps the tax-advantaged growth. However, this is where many filmmakers fall into a tax trap. The $80,000 Alex is paying out is after-tax cash. The $300,000 in the 401k is pre-tax money. In 2026, with the 401k contribution limit sitting at $24,500, Alex is essentially holding a tax-deferred liability. When he eventually withdraws that money at retirement, he will owe federal and state income taxes on every cent. If his combined tax rate is 30%, that $300,000 is actually only worth $210,000 in real-world purchasing power. By paying out $80,000 in cash to keep the full 401k, Alex might actually be overpaying for his own asset. Plus one. Case studies from recent years show that the most successful negotiations in the creative sector involve a tax-adjusted valuation. This involves a financial expert calculating the net after-tax value of the retirement account before the split is even discussed. For a filmmaker earning over $160,000, which is the 2026 threshold for a highly compensated employee, this calculation is vital. In 2026, the IRS also mandates that catch-up contributions for these high earners must be made on a Roth basis. This adds another layer of complexity. Alex might have a traditional 401k component and a Roth 401k component within the same plan. The traditional portion is taxed upon withdrawal, while the Roth portion is tax-free. If the divorce decree simply says half of the 401k, does that mean half of each bucket? Or can the spouse take the entire Roth portion, leaving Alex with the tax-heavy traditional portion? Plus one. Step by step, the discovery process must include a plan summary description, or SPD. This is the manual that governs how the specific 401k plan operates. Not all plans are created equal. Some indie production plans may not allow for in-service distributions via QDRO, meaning the spouse cannot get their money until Alex actually leaves the job or retires. Imagine the tension of being legally divorced, but financially tethered to an ex-spouse's employment status for the next 20 years. This open loop in the legal paperwork is why so many independent film professionals find themselves back in court years after the divorce was supposed to be over. There is also the loan default catastrophe. It is common in the industry to take a loan from a 401k to fund a passion project or cover a gap between gigs. In 2026, if Alex has an outstanding $40,000 loan against his 401k, the court must decide how to treat that debt. Is it a marital debt used to support the family, or a separate debt used for Alex's career? If the plan requires the loan to be paid back immediately upon a distributable event, like a QDRO transfer, and Alex doesn't have the cash, the IRS will treat the unpaid balance as a deemed distribution. This triggers immediate income tax and, if Alex is under 59 and a half, a 10% early withdrawal penalty. Suddenly, a $40,000 loan becomes a $60,000 problem. As we look toward the administrative side of this disaster, we have to talk about the gatekeepers, the plan administrators. These are not judges. They are corporate compliance officers who do not care about the fairness of your divorce. They only care if the QDRO matches their internal checklist. If you miss one comma or fail to name the alternate payee correctly, the document is worthless. This is where the most heart-wrenching stories of the indie film world happen. Not on screen, but in the rejection letters from financial institutions. But what happens when the 401k isn't just a standard account, but a specialized solo 401k, or a SEP IRA, used by high-level directors and producers? The rules of the game change entirely when you are both the employer and the employee. We are about to peel back the curtain on the owner-only retirement trap and why self-certification of hardship in 2026 is a double-edged sword that could either save your production or sink your settlement. In the next part, we dive into the specific mechanics of the solo 401k and why directors who own their own production companies are at the highest risk for plan disqualification during a divorce. We will also reveal the hidden math of the 401k loan offset, a strategy that could save you from the 10% penalty, provided you know the one federal exception that most divorce attorneys overlook. The transition from a standard employer-sponsored 401k to a solo 401k represents the ultimate level of financial autonomy for an independent filmmaker, but in the context of a 2026 divorce, it also represents the ultimate level of legal exposure. In the American indie film world, many directors and producers operate through their own S-Corp or LLCs to manage their production budgets and residuals. To maximize their retirement savings, they often utilize a solo 401k, which allows for much higher contribution limits than a standard IRA. However, the moment a marriage dissolves, the solo 401k stops being a private vault and becomes a glass box. Imagine a character named Sarah. Sarah is a highly successful independent director based in New York. By 2026, she has built a reputation for gritty, low-budget dramas that perform exceptionally well on streaming platforms. She operates through her company, Zenith Frame Productions. Over the last decade, Sarah has funneled her director fees and back-end points into a solo 401k, which now sits at $480,000. Her husband, Mark, has been a stay-at-home spouse who occasionally helped with location scouting and basic bookkeeping for Sarah's films. As they enter divorce proceedings in mid-2026, Sarah assumes that because the plan is in her name and she was the sole earner, the $480,000 is her creative war chest. The first point of failure in this scenario is the spouse as employee complication. A solo 401k is specifically designed for business owners with no employees, with one major exception: a spouse. If Mark was technically an employee of Zenith Frame Productions, even for a single project, the plan remains a solo 401k. However, if Sarah hired any other crew members as W-2 employees during those years and failed to offer them plan participation, the IRS may deem the entire solo 401k disqualified. Historical trends show that in the rush to wrap production, many indie filmmakers misclassify their crew as independent contractors. If a divorce attorney discovers that Sarah had de facto employees who should have been in the plan, the tax-exempt status of that $480,000 could be revoked. This would result in Sarah being hit with back taxes and massive penalties for every year the plan was out of compliance, effectively vaporizing a significant portion of the asset before the divorce even reaches a settlement. This brings us to the specific mechanics of the owner-only retirement trap. In a standard corporate 401k, a neutral third-party HR department handles the qualified domestic relations order. In Sarah's case, she is the plan administrator. This means Sarah is legally required to act as a fiduciary for the plan, even when the person she is transferring money to is her soon-to-be ex-husband. If Sarah tries to obstruct the process, she isn't just being a difficult litigant. She is violating federal ERISA laws. Case studies suggest that when a filmmaker acts as their own administrator, they often fail to realize that they must formally adopt a QDRO. You cannot simply cut a check from the solo 401k bank account to an ex-spouse. Doing so constitutes a prohibited transaction, which can lead to the immediate taxation of the entire account balance at Sarah's 2026 marginal tax rate. Now, let's reveal the hidden math of the 401k loan offset, which is the strategy that most divorce attorneys in the creative sector completely overlook. Suppose Sarah took a $50,000 loan from her solo 401k in 2025 to finish the post-production on her latest feature. In 2026, she still owes $40,000 to the plan. In a typical divorce, Sarah might think she has to pay that $40,000 back immediately or face taxes. However, Section 72(t)(2)(c) of the Internal Revenue Code provides a specialized pathway when dealing with QDROs. While a standard withdrawal from a 401k before age 59 and a half triggers a 10% early withdrawal penalty, a distribution made to an alternate payee, like Mark, pursuant to a QDRO is exempt from that 10% penalty. The hidden math strategy works like this. Instead of Sarah paying back the $40,000 loan with after-tax money, the divorce decree can be structured to treat the outstanding loan as part of Mark's distribution. If Mark is owed $200,000 of the account, he can be assigned the $40,000 loan as a deemed distribution as part of his share. Because this happens via the QDRO process, the 10% penalty is bypassed. Mark would still owe income tax on that $40,000 if he doesn't roll it over, but Sarah is suddenly relieved of the debt without having to drain her cash reserves. This is a potential outcome that requires surgical precision in the legal drafting, yet it is rarely utilized because it requires the divorce attorney to understand the internal plumbing of the tax code. Step by step, the process for a filmmaker in 2026 to execute this requires a specific sequence. First, you must obtain a formal valuation of the 401k as of the date of separation. Second, you must verify the plan's participant loan account balance. Third, the QDRO must explicitly state that the loan is being assigned to the non-participant spouse as a taxable distribution under the 72(t) exception. If the wording is off by even a few syllables, the IRS will not recognize the exception, and the 10% penalty will be reinstated. Furthermore, we must discuss the self-certification of hardship rules that have evolved by 2026. Under the Secure 2.0 framework, individuals can now self-certify for certain emergency distributions. Some filmmakers might be tempted to use this to pull money out of the 401k during a divorce to pay for legal fees, or to keep their production company afloat during the lean months of a trial. While this provides immediate liquidity, it is a high-risk move in a divorce. If the court determines that Sarah dissipated marital assets by taking an emergency distribution without Mark's consent, the judge can add back that money to her side of the ledger during the final division. Essentially, she would be spending her own future retirement money twice, once at the time of the withdrawal and again when the court subtracts that amount from her remaining share of the marital estate. Imagine if Sarah also has a SEP IRA, which is common for freelancers. Unlike a 401k, a SEP IRA does not require a QDRO for a transfer. It only requires a standard letter of instruction to the financial institution. This makes it much easier to divide, but it lacks the 10% penalty protection that the 401k QDRO provides. This creates a strategic crossroads. If Sarah has both a 401k and a SEP IRA, and she needs to give Mark $200,000, it is almost always mathematically superior to take that money from the 401k via QDRO. This is because it preserves the liquidity options for the spouse, while protecting the filmmaker from the immediate tax fallout of a direct IRA transfer. Historical trends in the U.S. creative economy for 2026 show an increase in gray divorce among established filmmakers who have spent decades building these accounts. For these veterans, the 401k isn't just a number. It's the bridge to their legacy phase, where they can fund their own projects without studio interference. Losing 40% of that bridge to tax inefficiency and poor legal drafting is a professional tragedy. The key is to stop viewing the 401k as a bank account and start viewing it as a complex legal trust that requires a specialist touch. But what happens when the 401k isn't the only thing at stake? In the American independent film world, the 401k is often inextricably linked to the production company's intellectual property. If the 401k was used as collateral for a production loan, or if the retirement funds were invested in a self-directed 401k that owns the actual masters of a film, the divorce moves from a financial dispute to a battle over creative control. In the next part, we will explore the nightmare of the self-directed 401k and the checkbook control model. We will analyze what happens when your retirement account literally owns your movies, and how a divorce can force a fire sale of your film library to satisfy a QDRO. We are moving into the territory where the art and the assets become one, and the legal system is forced to put a price tag on your creative soul. When a filmmaker moves beyond the standard mutual funds of a traditional 401k and enters the realm of the self-directed 401k, the complexity of a divorce doesn't just increase, it mutates. In the American independent film industry of 2026, the self-directed 401k with checkbook control has become a popular vehicle for seasoned producers to invest in what they know best, intellectual property. But when that marriage hits the rocks, the legal system is forced to perform an autopsy on a living, breathing creative business. Imagine a character named James. James is a prolific independent producer based in Austin, Texas. Over the last decade, James has utilized a self-directed solo 401k to move away from the volatility of the S&P 500. Instead, his retirement account owns a specialized limited liability company, an SPV or special purpose vehicle, that holds the master recordings and copyright titles to 5 award-winning independent horror films. In James's mind, this was the ultimate hedge. While the market fluctuated, his horror library continued to generate steady residuals from streaming platforms and international licensing. By early 2026, James's 401k-owned LLC is valued at approximately $850,000. However, James is now navigating a divorce from his spouse, Maria. In the eyes of the court, that horror library isn't a collection of art. It is a marital asset that must be valued, divided, and potentially liquidated. This is where we encounter the first massive hurdle of the self-directed 401k divorce, the valuation deadlock. Unlike a standard 401k where you can simply log into a portal and see a real-time balance, James's assets are liquid. To satisfy a court in 2026, a simple guess won't suffice. Historical trends in film finance suggest that the valuation of a film library must account for the decaying nature of traditional licensing versus the emerging revenue streams of the late 2020s. For instance, in 2026, a major component of film valuation involves AI training data licenses. Companies are paying top dollar to license high-quality film libraries to train their video generation models. This creates a potential outcome where James's library is worth significantly more than it was 2 years ago, but only if he can find a qualified appraiser who understands these new digital rights. If Maria's legal team hires an appraiser who specializes in traditional media, and James hires one who understands AI licensing, the two valuations could be hundreds of thousands of dollars apart. The court then becomes a battleground of expert witnesses, with James's retirement savings being drained by the very process meant to protect them. Step by step, the division of a self-directed 401k requires a process known as an in-kind transfer via QDRO. If James cannot or does not want to sell the film rights, the court may order that a portion of the membership interest in the 401k-owned LLC be transferred to Maria. Imagine the logistical nightmare of James and Maria, now divorced, both owning shares of an LLC that is nested inside James's retirement plan. This leads directly into the danger zone of prohibited transactions under Internal Revenue Code Section 4975. In 2026, the IRS remains incredibly strict about self-dealing. If Maria is awarded 40% of the LLC but James continues to manage the day-to-day distribution deals, the IRS could argue that James is providing a service to a disqualified person, his ex-spouse, depending on how the decree is structured. If the IRS deems this a prohibited transaction, the entire 401k could lose its tax-deferred status. James would be hit with an immediate tax bill on the full $850,000 valuation, potentially forcing a fire sale of his life's work just to pay the government. Case studies of similar high-asset divorces in the creative sector show that the most common resolution is the asset offset strategy. But in 2026, the math has changed. James might attempt to give Maria the family home in exchange for keeping his 401k-owned film library. However, the court must account for the tax-equivalent value. A house worth $500,000 is not equal to $500,000 in a 401k. The house has a primary residence capital gains exclusion, while the 401k assets will be taxed as ordinary income upon withdrawal. To make the trade fair, James's attorney must apply a discount to the 401k's value to account for that future tax liability. If James fails to do this, he is effectively overpaying Maria by 6 figures. Furthermore, we must address the liquidity gap. If Maria insists on a cash payout rather than an in-kind transfer of film rights, James is in a bind. The 401k-owned LLC might have $850,000 in value, but only $20,000 in actual cash. To get Maria her share, James would have to sell the film rights. Historical trends in the independent film market show that forced sales, or fire sales, rarely result in fair market value. If James is forced to sell the masters to his horror films in a 60-day window to satisfy a divorce decree, he might only receive 50 cents on the dollar. This doesn't just hurt James. It destroys the long-term wealth of the entire family unit. Imagine if James's self-directed 401k also holds a portfolio of Bitcoin or other digital assets, which is common for tech-forward filmmakers in 2026. While these are more liquid than film rights, they introduce the problem of basis tracing. If James bought the Bitcoin in 2022 using 401k funds, and the value has tripled by 2026, the gain is all tax-deferred inside the plan. But if Maria wants the Bitcoin transferred to her own IRA, the custodian of the self-directed 401k must be able to facilitate a like-kind transfer. Many boutique custodians who handle self-directed plans are not equipped for the rapid-fire demands of a divorce court. A delay in the transfer during a period of high market volatility could lead to Maria receiving significantly less value than the court intended, leading to further litigation and contempt of court charges against James. Step by step, James must also navigate the Qualified Joint and Survivor Annuity or QJSA requirements. Many filmmakers are unaware that under ERISA, if their 401k is structured in a certain way, the spouse has a legal right to a survivor annuity that can only be waived with a specific, notarized signature. Even in a divorce, if the QDRO is not drafted to specifically address and terminate these survivor rights, James might find that decades from now, his ex-spouse is still legally entitled to a portion of his monthly retirement income, regardless of what the rest of the divorce decree says. This is a potential outcome that creates a financial ghost that haunts the filmmaker long after the creative spark has faded. As we look deeper into the administrative weeds, we have to consider the role of the 401k's trustee. In a solo 401k, James is the trustee. This gives him checkbook control, meaning he can sign the checks for the LLC. During a divorce, this control is often viewed with extreme suspicion by the court. Maria's lawyers might request a fiduciary audit, where every single check James wrote from the 401k over the last 5 years is scrutinized. If James used 401k money to pay for a research trip to a film festival that looked a lot like a vacation, or if he bought a piece of camera equipment that he also used for personal projects, he has committed a prohibited transaction. In a divorce, these small errors are weaponized to disqualify the plan's tax status, giving the non-participant spouse massive leverage in negotiations. The pressure of a self-directed 401k divorce in 2026 is an exercise in high-stakes strategy. It requires a filmmaker to be part artist, part accountant, and part litigator. We have seen how the intersection of illiquid assets, AI licensing valuations, and IRS prohibited transaction rules can create a perfect storm that sinks even the most successful production companies. But there is a final, even more complex layer to this story. What happens when the 401k isn't just owning movies, but is actually the primary lender for the filmmaker's current production? If your retirement account is the bank for your movie, and your divorce freezes that bank account, your production grinds to a halt. In the next part, we will explore the production freeze nightmare, the specific legal mechanics of how a divorce can trigger a breach of contract with your cast and crew because your 401k is tied up in a QDRO dispute. We will also look at the cashing out versus rolling over dilemma in 2026, and the one specific IRS rule that allows a divorced spouse to take a cash distribution from a 401k without the 10% penalty, a rule that could be the only way to save a failing film project. This specific IRS rule is found in Section 72D, 2C, and in the high-pressure environment of 2026 independent film production, it is often the only escape hatch when a project is threatened by a freeze on marital assets. To understand how this works, we must first look at the traditional penalty structure. Normally, if you are under the age of 59 and a half, and you withdraw funds from your 401k, you are hit with a 10% early withdrawal penalty in addition to standard income taxes. However, the Internal Revenue Code provides a very specific exception for distributions made to an alternate payee pursuant to a qualified domestic relations order. This means that if a divorce decree awards a portion of a 401k to a spouse, that spouse can choose to take that money as a direct cash distribution, and the 10% penalty is waived. Imagine a case study involving a producer named Michael. It is 2026, and Michael is in the middle of principal photography for a mid-budget independent thriller titled The Last Aperture. To fund the final 3 weeks of the shoot, Michael utilized a sophisticated financing structure where his solo 401k provided a bridge loan to his production company. This is a legal but complex maneuver that many top-tier indie producers use to avoid high-interest commercial debt, which in 2026 has remained stubbornly high. Suddenly, Michael's marriage of 12 years ends, and his spouse, Sarah, files for a joinder in the family court proceedings. In the United States legal system, a joinder is a procedural move that brings the retirement plan itself into the divorce as a party. Once the 401k plan is joined, the plan administrator is legally required to freeze the account to prevent any further loans, withdrawals, or investment changes until a final QDRO is issued. For Michael, this is a catastrophe. The next tranche of funding for his film is locked inside that frozen 401k. He cannot pay his IATSE crew, he cannot secure the location for the climactic scene, and he is facing a potential breach of contract with his lead actors. Historical trends in 2026 show that these production freezes are becoming more common as more filmmakers move their wealth into self-directed retirement vehicles. The solution often lies in the tactical use of Section 72(t)(2)(c). During the settlement negotiations, Michael's legal team proposes a strategic distribution. Instead of Michael trying to fight to keep the entire 401k, he agrees to award Sarah a significant cash portion of the account immediately via a QDRO. Because Sarah is the alternate payee, she can receive this cash without the 10% penalty. Michael, in turn, negotiates that Sarah will use a portion of that liquidity to buy out his interest in another marital asset, such as a shared production office or a library of digital assets, which Michael can then immediately leverage or sell to fund the completion of The Last Aperture. Step by step, the execution of this strategy requires extreme care. First, the QDRO must be drafted to specify that the distribution is a total cash-out of the awarded portion. Second, the parties must account for the mandatory 20% federal income tax withholding. If Sarah is awarded $100,000, the plan administrator will automatically send $20,000 to the IRS. Sarah only receives $80,000 in her bank account. In the 2026 tax environment, where brackets have shifted to account for recent economic volatility, this 20% might not cover Sarah's total tax liability at the end of the year. If she is in a higher bracket, she might owe an additional 10 to 15% when she files her returns. Case studies from 2025 and early 2026 suggest that many filmmakers fail because they confuse a 401k distribution with a 401k loan. If Michael had simply tried to take more money out as a loan to pay off Sarah, he would be limited by the $50,000 federal loan cap, and he would have to pay it back with interest using after-tax dollars. By using the QDRO cash-out exception, the money leaves the 401k permanently, the 10% penalty is avoided, and the liquidity is injected into the marital estate exactly when it is needed most to prevent a production collapse. However, there is a massive rolling over trap that catches many independent film professionals. If Sarah receives the QDRO and decides to roll that money over into her own traditional IRA, the Section 72(t)(2)(c) protection vanishes the moment the money hits the IRA. If she needs cash 2 months later to pay for her own legal fees or a new apartment, and she takes it out of that IRA, she will be hit with the 10% penalty because the QDRO exception only applies to distributions directly from the employer-sponsored 401k plan. Historical trends show that thousands of divorcees lose millions of dollars every year because their financial advisors move the money into an IRA too quickly, before determining if the spouse needs immediate liquidity. In the context of the American independent film industry, this liquidity is often the lifeblood of the creativity-to-market pipeline. In 2026, the cost of completing a film, covering color grading, sound mixing, and DCP creation, has risen by nearly 15% due to the integration of advanced AI-driven post-production tools. A filmmaker who is asset-rich in their 401k but cash-poor on set is a filmmaker whose project will die in the editing room. This is why the 401k divorce in the indie world is rarely about the retirement date. It is about the production date. Imagine if Michael's film was being produced under a SAG-AFTRA low-budget agreement. The bond company or the union may require proof of funds to ensure that residuals and fringes are covered. If the 401k is frozen, that proof of funds is gone. By utilizing the cash-out exception, Sarah gets her settlement, the freeze is lifted, and Michael can demonstrate the necessary liquidity to keep the bond company from pulling the plug. It is a potential outcome where everyone wins, but it requires a level of cooperation that is often difficult to find in the heat of a legal battle. We also have to analyze the tax bracket timing of these moves. If a filmmaker is having a breakout year in 2026 with high residuals from a previous hit, their income might be in the highest federal bracket. Taking a large 401k distribution in the same year could push their effective tax rate to nearly 40% when combined with state taxes in film hubs like New York or California. Step by step, a savvy filmmaker might try to delay the final QDRO distribution until January 1st of the following year, assuming their income will be lower, to minimize the tax bite. But in a divorce, the other spouse rarely wants to wait, creating a high-stakes game of tax chicken, where the winner is the one who can afford the best forensic accountant. Furthermore, we must look at the 2026 contribution limits. For a filmmaker over age 50, the catch-up contribution allows them to put nearly $31,000 into their 401k annually. If Michael loses half of his 401k in 2026, his ability to rebuild the account is limited by these federal caps. It could take him over a decade of maximum contributions just to return to his pre-divorce balance. This reality often leads to creative settlement structures, where the filmmaker gives up a larger share of future residuals, which are speculative, to protect the guaranteed tax-advantaged capital already sitting in the 401k. But there is a darker side to this math. What happens when the 401k isn't just holding cash and stocks, but is holding the actual physical assets of the film company? In the world of high-end indie production, some 401ks own the specialized cameras the server farms use for rendering, and even the lease on the soundstage. When the 401k is divided, you aren't just dividing money. You are dividing the tools of the trade. In the next part, we will explore the asset seizure nightmare. We will dive into what happens when a QDRO forces the sale of production equipment, and how equipment appraisal, in the age of rapid technological obsolescence, can make or break your financial future. We will also reveal the residual offset trick, a method used by top Hollywood lawyers to keep the 401k intact by trading away the rights to future sequels and spin-offs. This is where the true value of your career is weighed against the cold, hard numbers of your retirement. The intersection of career survival and retirement security becomes most volatile when we examine the actual physical and intellectual assets held within these specialized accounts. To understand the gravity of this, let us look at a case study involving a cinematographer named Christopher. In the year 2026, Christopher has established himself as a go-to director of photography for high-end independent features and premium streaming series. Over the last decade, he has operated a solo 401k that doesn't just hold index funds. It holds his primary livelihood, a high-end camera package, including two ARRI Alexa 35 bodies and a rare set of vintage anamorphic lenses. In the independent film world, owning your gear is a primary way to secure work. Production companies often hire the DP and rent their gear as a package, allowing the filmmaker to capture rental income that is funneled directly into their retirement account as a business contribution. By 2026, Christopher's equipment, held inside his 401k structure, is valued at $280,000. When Christopher and his spouse, Emily, begin their divorce proceedings, the legal system treats these cameras not as tools of a trade, but as a liquidatable retirement asset. Imagine if the court orders a 50-50 split of the 401k. Christopher faces a devastating potential outcome. If the account lacks enough cash to pay Emily her $140,000 share, Christopher might be forced to sell the very equipment he needs to earn a living. This is the equipment seizure nightmare. In 2026, the secondary market for cinema gear is undergoing a radical shift. With the rapid advancement of AI-integrated sensors and the rise of high-fidelity virtual production stages, the fair market value of digital camera bodies is depreciating faster than historical trends ever predicted. If Christopher is forced to sell his gear in a fire sale environment to satisfy a QDRO, he might only receive 60 cents on the dollar. However, the court often uses a replacement value, or an appraised value, based on the last 12 months of sales. This creates a valuation gap where Christopher is legally obligated to pay Emily based on an inflated number, while the actual cash he can generate from a sale is significantly lower. Step by step, Christopher's legal team must argue for a liquidity discount, or a disposition cost adjustment. They must prove to the court that the cost of selling the equipment, including broker fees, shipping, and the inherent loss in a forced sale, should be deducted from the total valuation before the split. Furthermore, we must address the 2026 technological obsolescence factor. In 2026, A camera body that was industry standard in 2024 might be considered legacy hardware due to new software-defined imaging standards. If the appraiser doesn't understand the nuance of the indie film gear cycle, Christopher could be trapped in a settlement that assumes his gear will hold its value for another 5 years. This is why forensic equipment appraisal has become a specialized field within entertainment law. To avoid losing his cameras, Christopher might turn to the residual offset trick. This is a high-stakes negotiation tactic used by top-tier Hollywood lawyers to protect the 401k and the tools of the trade. Christopher has back-end points on 3 independent films he shot between 2022 and 2025. In 2026, these films are performing well on international streaming platforms. These residuals are a marital asset because the work was performed during the marriage. The strategy works like this. Instead of splitting the 401k and the camera gear, Christopher offers Emily a larger percentage of his future residuals. This is a trade of speculative future income for current tangible assets. For Emily, this represents a potential outcome of long-term passive income. For Christopher, it allows him to keep his 401k intact and his camera package in his hand so he can continue working. However, the math behind this trade is incredibly complex in 2026. To make a fair trade, the parties must calculate the net present value or NPV of those future residuals. This requires a discounted cash flow analysis. Historical trends show that independent film residuals often follow a long-tail decay curve. High income in the first 2 years, followed by a sharp drop, then a long, slow trickle of income over the next 20 years. In 2026, the volatility of streaming royalty structures makes this calculation even more difficult. If the streaming platforms shift their payment models again, the residuals Christopher traded away could either become a goldmine for Emily or a worthless stream of pennies. Step by step, a filmmaker must hire a royalty auditor to project these earnings. If the projection is too high, Christopher gives away too much of his future. If it is too low, Emily's lawyers will reject the deal. This is where we see the intersection of personal goodwill and enterprise goodwill. The court must determine if the residuals are coming to Christopher because of the business he built or because of his personal talent. In many U.S. jurisdictions, personal goodwill is not a divisible marital asset. If Christopher can prove that the high rental rates for his gear and his back-end points are tied specifically to his unique skill as a cinematographer, he may be able to shield a portion of that value from the divorce settlement. But what happens when the 401k holds the actual intellectual property rights? Imagine a filmmaker who used their 401k to buy the remake rights to an old foreign film or the sequel rights to a successful indie. In 2026, IP aggregation is a major trend, and these rights are highly valuable. If the 401k is split, the control rights are also split. If Christopher and Emily each own 50% of the sequel rights to a hit film, they are now co-owners. This means any future deal to produce a sequel or sell the rights to a major studio requires both of their signatures. In the history of American independent film, co-ownership between ex-spouses is a recipe for development hell. If one party wants to sell the rights for $500,000 and the other insists they are worth $1 million, the asset becomes encumbered. A studio will almost never greenlight a project with encumbered IP. This effectively freezes the asset, rendering it worthless to both parties until one buys out the other. Case studies from 2024 and 2025 show that these IP deadlocks often lead to a forced auction, where the rights are sold to a third party at a discount just to end the litigation. As we move into the deeper administrative layers of 2026, we also have to consider the business partner complication. Many independent filmmakers don't work alone. They have production companies with partners. If your 401k owns a stake in a production company, and that company is now subject to a QDRO, your business partners are suddenly in bed with your ex-spouse. This can trigger buy-sell agreements and right of first refusal clauses that were buried in the company's operating agreement years ago. The 401k divorce in the indie film world is a chess match where the pieces are cameras, hard drives, and copyright certificates. We have explored how to protect the physical tools and how to trade speculative residuals for retirement security. But there is a final, even more dangerous loop. What happens when your 401k is the limited partner in a film fund that has not yet closed? If your retirement money is committed capital for a project that hasn't shot yet, a divorce doesn't just split the account, it threatens the entire fund's viability. In the next part, we will dive into the committed capital crisis. We will analyze the legal mechanics of defaulting on a 401k investment commitment because of a divorce-induced freeze. We will also reveal the reverse QDRO, a rare and controversial method used to move assets into a 401k during a divorce to settle debts, and why the IRS is keeping a closer eye on this in 2026 than ever before. We are reaching the point where the divorce isn't just about the past. It is a direct threat to every future project you have on your slate. The committed capital crisis is the ticking time bomb of the American independent film world, and in 2026, it has become the most frequent cause of total financial collapse during a high-stakes divorce. To understand this, we must look at how the modern indie producer actually uses their solo 401k. It is no longer just a bucket for Vanguard index funds. By 2026, the trend of being a limited partner within your own retirement plan has reached a fever pitch. Producers are using their 401k funds to sign subscription agreements with private equity film funds or slate financing vehicles. This is not a simple purchase of shares. It is a legal commitment to provide capital on demand. Imagine a case study involving a producer named David. David is a veteran of the Sundance circuit who, in 2024, committed $200,000 from his solo 401k to a genre-specific film fund. Under the terms of the subscription agreement, David paid an initial $50,000, leaving a $150,000 outstanding commitment. In early 2026, as David is navigating a contentious divorce from his spouse, Linda, the film fund issues a capital call. They need the remaining $150,000 within 21 days to greenlight a highly anticipated survival horror film that already has a pre-buy deal with a major global streamer. The collision of family law and private equity is where the disaster begins. Because the divorce is active, David's solo 401k is subject to a joinder and a temporary restraining order on the movement of assets. David literally cannot fulfill the capital call because his plan administrator, even if that administrator is himself, is legally barred from moving the money until the court determines Linda's marital share. This is the moment David faces a default. Historical trends in private equity show that subscription agreements contain draconian bad boy clauses for defaulting limited partners. If David misses that capital call, the fund has the right to seize his existing $50,000 interest for a nominal sum, or worse, sue his 401k plan for the balance. For an independent filmmaker, a default like this is a career-ending event. In the indie ecosystem, your reputation is your ability to close. If David defaults on a fund, word spreads through the tight-knit Austin and Los Angeles production communities within 48 hours. No bond company will sign off on his future projects, and no private investor will trust his committed capital again. Step by step, David's legal team must move for an ex parte emergency order to lift the freeze specifically for the purpose of satisfying the capital call. However, Linda's lawyers may argue that by paying the capital call, David is locking up marital funds in an illiquid asset to prevent her from accessing her cash settlement. They might demand that David pay the capital call using non-retirement funds, which David simply doesn't have because his liquidity is tied up in the 401k. This leads us to the rare and highly controversial reverse QDRO strategy, a term used in 2026 by specialized entertainment family law hybrid firms. While a traditional QDRO moves money out of a plan to a spouse, a reverse logic settlement focuses on using the QDRO framework to recharacterize marital obligations to save the plan's standing. In this scenario, David and Linda agree to a QDRO waiver and offset. Linda formally waives her right to a 50% split of the 401k. In exchange, the court issues a decree that assigns her a super priority interest in David's other marital assets, perhaps the future residuals of his existing library, or the full equity in a production office. This move allows David to satisfy the capital call and keep his reputation intact. But here is where the 2026 IRS scrutiny becomes intense. The IRS, utilizing its new AI-driven real-time compliance engine, flags any 401k that shows significant movement or atypical activity during a divorce. If the IRS determines that David used the reverse logic to effectively overfund his 401k with marital assets that should have been taxed, they can disqualify the entire plan. In 2026, the Secure 2.0 regulations have been fully integrated with the IRS's digital reporting systems. Any discrepancy between the date of separation valuation and the post-settlement balance is automatically audited. Furthermore, we must analyze the role of the general partner, or GP, of the film fund. In 2026, many film funds have divorce clauses in their operating agreements. These clauses state that if a limited partner undergoes a divorce, The GP has the right of first refusal to buy out the partner's interest at a distressed valuation. This is a potential outcome that many filmmakers ignore. If David's 401k interest is worth $200,000 on paper, but the GP has the right to buy it for $100,000 because of the divorce filing, the marital estate just lost 50% of its value. Linda's lawyers will then sue David for waste of marital assets, arguing that his choice of investment vehicle created this vulnerability. To navigate this, filmmakers in 2026 are increasingly using trust-owned 401ks, or multi-layered LLC structures. Step by step, this involves the solo 401k owning an LLC, which then enters into the subscription agreement. This creates a corporate veil that can sometimes shield the investment from the immediate impact of a personal divorce freeze. But even this is not a perfect shield. U.S. courts are increasingly piercing the veil in 2026 when they believe a creative professional is using complex structures to hide the true value of their retirement savings. Imagine if the horror film David Was Funding becomes a massive hit. If the divorce settlement was finalized based on a default valuation, while the film was in limbo, but then the film sells for $20 million, Linda may attempt a post-judgment set-aside. She could argue that David committed fraudulent concealment by downplaying the potential outcome of the investment. In the world of independent film, where a movie's value can go from zero to millions overnight, the timing of valuation is the difference between a clean break and a decade of litigation. Historical trends show that the most successful committed capital resolutions involve a tri-party agreement between the filmmaker, the ex-spouse, and the general partner of the fund. In this 2026 model, the spouse is granted a beneficial interest in the 401k's future distributions without actually becoming a partner in the fund. This keeps the GP happy because they don't have an unvetted ex-spouse voting on fund matters, and it keeps the IRS happy because the money stays within the 401k envelope until a distributable event occurs. But there is a final, even more complex open loop in this 2026 landscape. What happens when the 401k isn't just an investor, but is the security interest for a production loan? If David used his retirement account to backstop a loan from a boutique film bank, and the divorce triggers a default of security, the bank can call the entire loan due immediately. We are entering the territory of the cross-collateralization collapse. In the next part, we will explore the nightmare of the production loan default. We will analyze how a 401k freeze can trigger acceleration clauses in your film's financing, leading to a total seizure of your masters by the bank. We will also reveal the Social Security offset secret, the only way to balance the scales when one spouse has a massive 401k, and the other has nothing but a work history that the government hasn't yet paid out. This is where we look at the hidden retirement assets that the 401k statements never show. The production loan default is the nightmare scenario that turns a private family matter into a public industry catastrophe. To understand the gravity of this situation in 2026, we have to look at the current state of independent film financing. In the United States, traditional banks have significantly tightened their lending criteria for creative projects. Most boutique entertainment lenders now require a filmmaker to provide a personal guarantee, often backed by a specific security interest in their liquid assets, including their 401k. Imagine a character named Robert. Robert is a veteran producer in Los Angeles who is currently in the middle of a high-concept science fiction project. To secure a $700,000 gap loan for the production, Robert used his $1.2401000 as the primary backstop. In early 2026, as Robert enters the third week of a 6-week shoot, he is served with divorce papers. In the eyes of the bank, this is not just a personal life event. It is a material adverse change, or a MAC. Most production loan agreements in 2026 contain a clause stating that any legal proceeding that threatens the stability of the collateral constitutes a technical default. The moment the divorce is filed, the 401k is automatically frozen by the plan administrator due to the standing orders in the family court. When the bank's compliance department runs its monthly audit of Robert's assets and sees the freeze, they immediately trigger the acceleration clause. The acceleration clause is a legal mechanism that allows the lender to demand the full repayment of the loan balance within a matter of days. Step by step, here is how the collapse happens. First, Robert receives a notice of default. He has exactly 10 days to cure the default by providing alternative collateral or paying down the loan. Because his 401k is his only significant liquid asset and it is currently locked in the divorce, he cannot move the money to satisfy the bank. Second, the bank moves to seize the secondary collateral, which in most indie film deals includes the copyright and the physical master files of the current production. Historical trends in the mid-2020s show that banks are less interested in finishing your movie than they are in recouping their capital through a quick sale of the intellectual property to a larger studio or a library aggregator. This brings us to the concept of cross-collateralization. Robert's film is not just backed by his 401k, it is likely cross-collateralized with the residuals of his previous films. When the bank accelerates the loan, they don't just stop at the current project. They can theoretically seize the incoming royalty checks from Robert's entire career history to pay off the debt. For an independent filmmaker, this is the end of the road. You lose the current film, you lose your retirement, and you lose the passive income from your past work. In a divorce, this creates a bizarre legal paradox. Robert's spouse, let's call her Jennifer, is suing for her share of the 401k. But by filing for divorce and triggering the freeze, she might inadvertently cause the bank to seize the very asset she is trying to split. This is a potential outcome where both parties end up with nothing, because they failed to coordinate with the lender before the filing. To prevent this, savvy filmmakers in 2026 are using the Social Security offset as a strategic defense. While everyone focuses on the 401k because it has a clear number on a statement, there is a hidden retirement asset that never shows up on a balance sheet: the present value of future Social Security benefits. In the United States, if a couple has been married for 10 years or more, the lower-earning spouse is entitled to claim spousal benefits based on the higher-earning spouse's work record. Imagine if Jennifer spent the marriage working as a freelance editor, primarily taking under-the-table jobs or working for low rates to support Robert's directing career. She may have very little in her own Social Security bucket. However, because they have been married for 12 years, the 10-year rule applies. Jennifer is entitled to 50% of Robert's Social Security benefit at retirement age without it reducing Robert's own payout. Historical trends in 2026 show that the present value of these future government payments can be worth hundreds of thousands of dollars. Step by step, Robert's attorney can hire an actuary to calculate what is known as the net present value of Jennifer's future spousal benefits. If the actuary determines that Jennifer's lifetime Social Security benefit from Robert's record is worth $300,000, Robert can argue that this should be used as an offset against his 401k. Case studies from recent family court rulings in 2025 and 2026 suggest that judges are becoming more receptive to this invisible equity argument. If Robert has a $1,401,000, Jennifer's half would normally be $500,000. But if she is already guaranteed $300,000 in value through Social Security credits earned during the marriage, Robert can argue that he only needs to give her $200,000 from the 401k to make her whole. This strategy is a lifesaver for the independent filmmaker because it keeps more cash in the 401k, which in turn keeps the bank from triggering the acceleration clause on the production loan. Furthermore, we must look at the 2026 tax environment for Social Security. With recent legislative adjustments aimed at stabilizing the trust fund, the full retirement age is a moving target. The calculation of the offset must be precise. You cannot simply use an online calculator. You need a formal report that accounts for projected inflation and interest rates in 2026. This report becomes a powerful bargaining chip. When Robert presents Jennifer's legal team with a document showing she is already set to receive a significant portion of her retirement needs from the federal government, it changes the tone of the negotiation from splitting the pie to balancing the retirement portfolio. But there is a catch. The Social Security offset only works if the marriage lasted 10 years. If Robert and Jennifer were married for 9 years and 11 months, that invisible equity vanishes completely. In the high-pressure world of indie film, where projects often keep couples apart for months at a time, the date of separation becomes a multimillion-dollar argument. If Robert can prove the marriage lasted long enough to trigger the 10-year rule, he saves his 401k and his movie. If Jennifer can prove they separated a month earlier, she can claim a full half of the 401k and the bank can still take the rest. As we move deeper into this masterclass, we have to address the most dangerous document in the entire process: the QDRO itself. Many people assume that once the judge signs the divorce decree, the battle is over. But for an independent filmmaker with a complex solo 401k or a self-directed plan, the judge's signature is just the beginning of a whole new war with the IRS and the plan custodians. In the next part, we will dive into the QDRO rejection loop. We will analyze why 90% of initial QDRO drafts are rejected by plan administrators, and how a single misplaced comma can trigger a tax event that wipes out your production budget. We will also reveal the separate interest versus shared interest dilemma, the one choice you must make in your QDRO that determines whether you are financially tied to your ex-spouse for the rest of your life. This is where we learn how to truly cut the cord without cutting your net worth in half. The signing of the divorce decree by a judge is often mistaken for the finish line, but for an independent film professional in 2026, it is merely the starting gun for the most bureaucratic and dangerous phase of the entire ordeal, the qualified domestic relations order approval process. This is the moment where the abstract legal concepts of the courtroom meet the cold, hard automated compliance systems of the financial world. You can have the most brilliant entertainment attorney in Los Angeles or New York, but if they do not understand the internal mechanics of your specific 401k plan administrator, your settlement is nothing more than an expensive piece of paper. To understand why this stage is so treacherous, we need to examine the rejection loop. Imagine a case study involving a production manager named Marcus. It is mid-2026, and Marcus has spent 18 months fighting a grueling divorce. His 401k, managed through a major industry payroll provider that handles thousands of independent crew members, is valued at $400,000. The judge has signed a decree stating that his ex-wife is entitled to 50% of the account. Marcus's family law attorney, who is a generalist and does not specialize in ERISA law, drafts a custom QDRO based on a template they have used for 20 years. They file it with the court, get the judge's signature, and mail it to the plan administrator. 30 days later, Marcus receives a thin envelope. It is a rejection letter. The plan administrator, which in 2026 uses an AI-driven compliance engine to vet all legal documents, has flagged 3 minor technical errors. First, the document refers to the account as a profit-sharing plan, but the legal plan document defines it as a 401k salary deferral plan. Second, the document fails to specify how to handle the division of outstanding loan balances. Third, it uses a valuation date that falls on a Sunday, which the plan's automated system cannot process because there is no closing market price. This is the start of the rejection loop. Each time the document is rejected, Marcus has to pay his attorney to revise it, pay the court to refile it, and wait another 30 to 60 days for the administrator to review it again. Historical trends suggest that over 70% of initial QDRO drafts are rejected, and for filmmakers with complex self-directed or industry-specific plans, this number is even higher. This leads us to the most critical strategic choice an independent filmmaker must make in their QDRO: the separate interest approach versus the shared interest approach. This is a fork in the road that will define your financial life for the next 40 years. Imagine a director named Chloe. She is 45 years old in 2026 and has a solo 401k that is being split with her ex-husband Tyler. If Chloe's attorney drafts the QDRO using the separate interest approach, the plan administrator will literally bifurcate the account. They will carve out Tyler's share and move it into a brand new independent account in his name. The separate interest approach is the gold standard for anyone in the creative class because it achieves a total clean break. Once the account is split, Tyler has his own account number, his own investment options, and his own beneficiary designations. If Chloe dies the following year, it has no impact on Tyler's money. If Tyler decides to withdraw his funds early and pay the taxes, it doesn't affect Chloe's tax bracket. More importantly, for an active filmmaker, once that separate account is created, the administrative freeze on Chloe's remaining funds is lifted. She can once again take loans to fund her productions or rebalance her portfolio to hedge against a volatile 2026 market. The shared interest approach, however, is a financial haunting. In this model, Tyler is not given his own account. Instead, he is merely awarded a share of every distribution Chloe takes when she eventually retires. This means Chloe and Tyler are tethered together indefinitely. If Chloe decides she never wants to retire and continues directing films into her 80s, Tyler doesn't receive a single penny. If Chloe dies before she starts taking distributions, Tyler's interest might vanish entirely depending on the plan's survivor benefit rules. In 2026, the shared interest approach is increasingly viewed as an outdated relic of the old studio pension system, yet it is still frequently used by attorneys who do not understand the high-stakes, high-mobility nature of the modern independent film career. Step by step, the process for a filmmaker to avoid the rejection loop involves a tactic known as pre-approval. In 2026, most major plan administrators offer a pre-approval service where you can submit a draft of the QDRO before it is ever signed by a judge. This is the secret weapon of the high-end entertainment lawyer. By getting the plan administrator to bless the document in its draft form, Marcus could have avoided 18 months of delays. The administrator's compliance officer provides a letter stating that if the document is signed as written, it will be accepted. This letter acts as a shield in court, preventing the other spouse's attorney from making last-minute changes that would trigger a rejection. Furthermore, we must address the 2026 administrative reality of digital vaults and ERISA AI. Most production site 401k plans have moved to fully paperless systems. If your QDRO requires a wet signature, but the plan's procedures mandate a digital certification, the document will be caught in a bureaucratic limbo. Independent filmmakers, who often move between production hubs in Atlanta, Albuquerque, and New Jersey, are particularly vulnerable to mail delays and lost paperwork. Historical trends in 2026 show a rise in lost account syndrome, where a filmmaker has several small 401k accounts from different production companies and fails to file QDROs for each one. If you have 4 different 401ks from 4 different films, you need 4 different QDROs. One decree does not rule them all. Imagine if Chloe's 401k contains illiquid assets, such as a minority stake in a post-production house or a portfolio of digital collectibles used for a film's marketing. In 2026, many specialized 401k plans allow for these alternative investments. Splitting these via QDRO is an administrative nightmare. The plan administrator may refuse to split the asset itself, forcing Chloe to liquidate the asset at a massive loss just to provide Tyler with a cash equivalent. This is where the in-kind transfer becomes essential. The QDRO must be drafted to explicitly allow for the transfer of non-cash assets, and the filmmaker must verify that the plan's custodian is actually capable of holding those assets in a new account for the ex-spouse. The potential outcomes for a poorly executed QDRO are not just delayed payments. They include the total loss of tax-deferred status. If the administrator processes a distribution but does not label it as a QDRO transfer because the paperwork was flawed, the IRS will treat it as a standard withdrawal. For a filmmaker in a high tax bracket, this could result in a 40% tax hit plus a 10% penalty. On a $200,000 transfer, that is a $100,000 error. In 2026, the IRS's automated systems are faster than ever at catching these discrepancies, leaving the filmmaker with no room for error. This brings us to the frozen horizon. From the moment the divorce starts until the QDRO is finalized and the funds are moved, your retirement account is in a state of suspended animation. You cannot touch it, you cannot use it as collateral, and in many cases you cannot even change your investment allocations. In a year like 2026, where the media landscape is shifting daily, being unable to move your money out of a declining asset class is a form of financial paralysis. The faster you move through the QDRO phase, the faster you can return to building your career. As we reach the final chapters of this masterclass, we have to look beyond the paperwork. We have to look at the psychological and professional toll of the long divorce. The administrative burden of a 401k split can consume hundreds of hours that should be spent on your craft. But there is a way to wrap this production with a clean break. In the final part of our deep dive, we will explore the post-divorce recovery blueprint. We will reveal the rebuilding phase, where we look at how to maximize your 2026 and 2027 contribution limits to catch up on lost time. We will also analyze the residual recapture strategy, a method to buy back your own film rights from your ex-spouse using your newly split 401k. Finally, we will provide the final wrap checklist, the 5 things every independent filmmaker must do in the 30 days following their QDRO approval to ensure their financial future is secure. This is the moment where you take back control of your narrative. The first act of this new chapter begins with a cold, analytical assessment of the rebuilding phase. For an independent filmmaker in 2026, time is the only asset that cannot be recouped, but the tax code provides several high-velocity pathways to repair the damage done to your retirement architecture. Imagine a character named Ethan. Ethan is a 48-year-old screenwriter and director who has just seen his $600,401,000 split down the middle. In the summer of 2026, as he surveys the remains of his Zenith Frame retirement account, he isn't just looking at a balance of $300,000. He is looking at a massive loss of compounded growth potential. However, 2026 marks the full implementation of the Secure 2.0 enhanced catch-up provisions. Step by step, Ethan must maximize his contribution limits to exploit the historical trends of market recovery. In 2026, the standard 401k contribution limit has risen to $24,500, but for those aged 50 and older, the catch-up contribution adds another $8,000. But the real 2026 advantage for a filmmaker with an S-corp is the employer-side contribution. By utilizing a solo 401k, Ethan can contribute up to 25% of his compensation as an employer, on top of his employee deferrals, bringing his total annual contribution potential to over $70,000. This is a potential outcome that allows a filmmaker to rebuild a six-figure loss in less than 5 years, provided they have a high-earning year from a streaming sale or a successful indie theatrical run. Case studies of high-earning creatives in 2026 show that the most effective rebuilding happens when the filmmaker shifts from a traditional 401k to a Roth 401k for their new contributions. While the traditional model provides an immediate tax break, the Roth model allows every dollar of growth to be tax-free upon withdrawal. For someone like Ethan, who expects his film library to increase in value over the next 20 years, paying the tax now at his 2026 rate is often mathematically superior to paying tax on a much larger sum in 2046. This is the pivot from defensive survival to offensive wealth building. Next, we must analyze the residual recapture strategy, which is the most sophisticated move in the 2026 indie film playbook. During the divorce, Ethan's ex-wife Olivia was awarded 40% of the future residuals of his 3 most successful films. This creates a messy long-term financial link. However, Ethan's newly split 401k, now a separate interest account, has the ability to act as an investment vehicle. Under specific IRS guidelines regarding self-directed accounts, Ethan can use his retirement funds to buy back the IP rights from Olivia. If Olivia prefers immediate cash over 20 years of trickling residuals, Ethan's 401k can purchase those rights from her at a fair market value determined by a 2026 appraisal. This move effectively reunifies the IP under Ethan's control, while allowing the future growth of those residuals to flow directly back into his tax-advantaged retirement account. Historical trends in entertainment law suggest that reunifying IP rights significantly increases the total value of a library, as it removes the encumbrances that prevent major studio acquisitions. For Ethan, this isn't just about retirement. It is about reclaiming his creative legacy. As we move toward the final wrap checklist, every independent filmmaker must execute 5 critical actions in the first 30 days following the QDRO approval. Failing to do these is a primary cause of secondary financial trauma. Step 1 is the immediate update of beneficiary designations. In the American legal system, a divorce decree does not automatically revoke a beneficiary designation on a 401k. If Ethan were to have a medical emergency 31 days after his divorce is finalized, and he hasn't updated his forms, the $300,000 remaining in his account would, in many jurisdictions, still go to Olivia. This is a potential outcome that has led to decades of litigation. In 2026, most plan administrators allow for digital beneficiary updates, but for a solo 401k, Ethan must physically update his plan's internal records to reflect his new estate plan. Step 2 is the cost basis audit. When a 401k is split, the tax basis of the assets is often misunderstood. If Ethan's account held stocks or film-related assets that have appreciated significantly, he must ensure the plan administrator has correctly assigned the original purchase price to his remaining shares. Without this documentation, Ethan could find himself paying capital gains or ordinary income tax on a gain that was actually part of the original marital estate. Step 3 is the risk tolerance realignment. A filmmaker's risk tolerance in their 30s is vastly different from their tolerance after a divorce in their late 40s. With half the capital, Ethan can no longer afford to be as aggressive with his retirement investments. In 2026, the volatility of the entertainment sector means that the retirement account must act as the stable anchor to the high-risk sale of the production company. Ethan must rebalance his portfolio to include more liquid, low-volatility assets to ensure he never has to halt a production again due to a lack of personal liquidity. Step 4 is the updating of the production company operating agreement. Most indie filmmakers use their 401k to backstop their LLCs. If the 401k was a member or a lender to the LLC, the divorce has likely triggered a change in control or a technical dissolution. Ethan must formally amend his operating agreement to reflect his new status as a single-member entity and to remove any language that granted his ex-spouse incidental rights to the 401k's assets. Step 5 is the 2026 tax strategy sync. Ethan must meet with his CPA to project his total 2026 tax liability, including any deemed distributions from the 401k split. If the QDRO resulted in a cash-out, there are complex reporting requirements on Form 1099-R. Misreporting this information is a leading cause of IRS audits in the creative sector. The 401k divorce in American independent film is more than a financial transaction. It is a structural renovation of your life. We have seen how the intersection of federal ERISA law, state community property rules, and the unique challenges of the film industry create a landscape of extreme risk and extreme opportunity. By moving through the discovery phase with transparency, utilizing the 72T exception for liquidity, and mastering the QDRO rejection loop, a filmmaker can emerge from a divorce with their career and their sanity intact. In 2026, the independent film scene continues to be the heart of American culture, but it requires a new kind of creative professional, one who is as comfortable with a spreadsheet as they are with a script. Your retirement account is not a static number. It is the fuel for your next 5 projects. Protecting it isn't just about greed. It is about ensuring that you have the resources to keep telling the stories that matter. The narrative of your career does not end with a divorce. It simply enters a more complex, more mature second act. But even as you master the mechanics of the 401k, there is one remaining shadow that many filmmakers ignore until it is far too late: the impact of global digital royalties and the new 2027 international tax treaties on your retirement distributions. If your 401k owns a movie that is a hit in Europe or Asia, your divorce settlement might be subject to international withholding laws that your domestic attorney has never even heard of. In our next deep dive series, we will break down the global royalty trap and how to shield your international film earnings from double taxation within your retirement plan. We will also reveal the 2027 strategies for IP-backed IRAs and how the next generation of filmmakers is bypassing traditional 401ks entirely to build creative wealth vaults. The battle for your financial future is moving to a global stage, and we are just getting started.